One, you know, it's been a very important group of stocks for portfolio managers here. I think it really saved a lot of people's bacon. And one of the challenges is that when you look at history, groups, especially concentrated performance like this, rarely can push through into the following year. In fact, you know, keep in mind, two of the FANG names were the worst stocks in 2014. So it's hard to sustain that performance.
So Tom, I'm curious, if these stocks break, right, these have been the crowded trades, if they break, does that change your bullish view on the market? Because you've been bullish and right for a while now.
Yeah, you know what, it's in our report, we analyze FANG, and it turns out when FANG-like performance takes place, value does poorly. So it's essentially a style by itself. So I think next year, if you see FANG topple, and in the past it never mattered, you know, owning these top 10 names, then you'll see value outperform. I mean, these are blue chip companies, so I don't think there are fundamental problems with it. It's just that after an 86% move and really elevated PEs, investors might find opportunities elsewhere.
I see
I
see an in-between mode, right? I'm certainly not bullish on high yield. You know, we've been the bears on the street for going on 15 months. I continue to be today. We're calling for negative total returns next year, but it doesn't have to be boom. Right? This can be actually something much more painful. In some ways, you want a cathartic moment so that the market can reprice and be healthier. And the worst case scenario is not how Carl characterized it. The worst case scenario is it's death by 1,000 cuts. I think it's because what a lot of people have been saying for some time now, this is just a commodity story, and there's a flight to quality, and the commodity sector is very much unloved right now. And the feeling is that there's this big bifurcation, that the U.S. economy is okay, and therefore high yield in general should be okay. So the commodity sectors are getting hit the hardest, and the rest of the market is doing okay. I'm actually more cautious because of that, because it's not just a commodity story. I take issue with that. Leverage in non-commodity high yield is the highest it's ever been.
Next Wednesday is by and large done in people's minds, and it looks like they're finally going to go forward. One thing I would say, Scott, looking back over the last 12, 18 months, is to remember that they have been tightening in the sense that they pulled out of QE. So there's already been that taking place from a monetary standpoint. This has been as well telegraphed as any rate rise probably in our lifetimes, and maybe for decades from here. So I think the market is expecting it. But the market reaction, which everybody always asks, what will be the near-term market reaction? Always hard to predict, but the market will be looking very closely at the language in the statement and the signaling around next year. How much, how fast, how frequently, everything along those lines.
Is there any chance of a surprise next week and that they, in fact, don't go?
I think very, very little. I think I don't think there's going to be much surprise in any direction. I think they'll go. I think they'll be cautious with the language, and they'll be clear that they're going to move at a methodical pace in 2016. So I think that they've telegraphed it, and they'll be really on message.